All right, hey guys, now we're going to be doing 21 to 30. Assume that banks hold no excess reserves. A decrease in the required reserve ratio will cause total reserves in banks, the money multiplier, and the money supply to change in which of the following ways. So, if they hold no excess reserves, right, that would mean that whatever is required is what they have in their bank. So, no extra money. Okay. So if we decrease the required reserve ratio, okay, did we change anything with the total reserves? No, right? What happened to their excess reserves? Their excess reserves will increase. If you're confused about what I'm saying, that's okay, because I'm going to give it an explanation. Let's say we have your assets and your liabilities, your balance sheet, remember? If you have deposits of $100,000. I'm just making these numbers up. So, and let's say the required reserve ratio is 10%. Again, I'm making that number up. How many required reserves do you need? 10,000. All you're going to do is 100,000 times 10,000. Okay. Now, let's say you have no excess reserves. So that would be excess would be zero. Okay. And then therefore your loans would be 90,000. If you're wondering how I got 90, remember this needs to be balanced. If you have deposits of 100, required reserves of 10, you need loans of 90. Now, if the reserve ratio decreases, let's say it's now 5%, how much are you required to have? You're required to have 5,000. Okay. How many do you have in reserves? Well, you still have the 10,000. Okay. The only thing now is that 5,000 is required. So you have 5,000 excess. So your total reserves do not change. Total reserves do not change. Now, what about the money multiplier? Remember, the money multiplier is 1 divided by the required reserve ratio. So beforehand, that was 1 divided by 10%. 10% is 0.10. You have to move the decimal over. You have to change it from a percent to a number. So that would be 1 divided by 0.10. So that would be 10. If your ratio decreases to 5%, well, that would be 1 divided by 0.05. Again, we're moving over 2 decimal places. And if you did the math here, that would be 20. So what happened to your multiplier? Your multiplier increases. Okay? So the final thing, what happens to the money supply? Well, because the reserve ratio goes down, you now have excess reserves. What can you do with those excess reserves? You can make loans with excess. If you make loans with the excess, the loans is money going into the circular flow, and then it multiplies. So therefore, the money supply will increase. So 21 is E. Okay. No change in the reserves because it went from required to excess. So no change in the total. Because the multiplier is 1 divided by R, okay, you will see that your multiplier will actually be increasing from 10 to 20. In this case, right, I can do different numbers for the reserve ratio, but either way, the multiplier will be increasing. And then finally, because the multiplier goes up and because you can make loans with the excess reserves, your multiplier will be, your money supply will be increasing. 22. If the consumer price index increases from 200 to 240 in a 1 year period, inflation is what? Inflation is new minus old divided by old times 100. So therefore, what's your new? 240 minus 200 divided by 200 times 100. If you're wondering what is new, read the question again. It says you're going from 200 to 240. So your new is 240. So if we did the math here, that would be 40 divided by 200 times 100. So then that would become 40 divided by 2, which would be 20. Okay? So therefore, 22 is B. 22 is B. New minus old divided by old. In the long run, a fully anticipated expansion of the money supply will do what? So, fully anticipated means that you already know what's going to happen. Okay, so, and it's the long run. So, what's the long run look like? We have the aggregate demand, and then we have the long run aggregate supply curve. Okay, so that's what it means by long run. Now, fully anticipated expansion of the money supply. So, money supply goes up, the nominal interest rate goes down, investment goes up, aggregate demand will go up. So aggregate demand will be going up. So what happened to price level? Price level increases. But what happened to the real GDP? The real GDP stays the same. Okay. So real GDP will stay the same. So increase in real GDP. No. A decrease in the real wage. That's not what we're talking about here on this question. Because of the money supply, this won't really change your wage. Okay, so we're not dealing with wage here. Now, an increase in both the nominal GDP and the price level. Okay. Oh, an increase in the real GDP. It won't be an increase in real GDP. Now, nominal, remember, was the output with the prices, right? So if your output stays the same, but your prices go up, your nominal will go up as well. So 23 is D. Okay, because of the increase in prices, your nominal GDP will go up. And since we're in the long run, you're dealing with the vertical line here. So we increase aggregate demand, but that does not change your real output. It does change price level. 24. Which of the following policy actions will promote long run economic growth? So we're trying to look in the long run, which is your changing your potential to make more stuff. Which one of these would change your potential? Remember in the previous video, I was talking about changes to technology, changes in your education, changes in your investment, things like this. Okay. So what if we were to decrease the investment tax credit? Well, if we decrease the tax credit, then that means people will invest less. That's not going to work. What if we decrease the money supply? Well, that would be less money, less demand. That's not going to do it. What if we increase unemployment compensation? Well, if we do that, more people want to be unemployed because you can make money if you're not working. What if we increase investment in human capital? Oh, there it is. More education. Increase in investment in human capital. Remember, human capital is your education and your skills. So if you invest in those things, you will be changing your potential. Okay, increasing tax rates on savings income. So basically, if you save your money, you pay more taxes. And obviously, that's not going to change your potential because you're paying more in taxes. That's not going to do it. 25. Which of the following transactions would increase the current account surplus in Japan's balance of payments account? So the current account, remember, was dealing with the exports and the imports. Okay, so would increase the current account. If you're increasing the current account, that means your exports go up or your imports go down. So which one of these would increase your exports? A Japan-based company sells roasted coffee to Canada. So that would be an increase in your exports. Okay. Mary, a Japanese investor, buys stock in a Japanese company. That would actually be changing the capital count. Bob, a Canadian, buys stock in a Japanese company. Same thing. D, a Japan-based company buys a piece of equipment from Germany. That would be an import. And then Arasti Artois, a French citizen, works at a Japanese company in Paris. So that one would be the money is he works at a Japanese company in Paris. So the money's going to Paris, right? Because he works at that company. So this will be actually changing this will be decreasing the account surplus, not increasing. The only way we can increase it is with the change in the exports. Number 26. Suppose countries Alphenia and Beta Inia produce electronics and apparel using identical resources. Which of the following is true if Alphenia exports electronics to and imports apparel from Beta Inia? I'm sorry, I'm just not going to be able to say those countries. Why would Beta why would Alpha export electronics and import apparel? Well, that would have to mean that Beta is better at the apparel and Alpha is better at the electronics. Remember, with like you only export what you're better in, right? The lower cost, you export the lower cost. You sell the lower cost. So for Alpha, they're going to export electronics. So that would mean they have a lower cost in electronics. What's another way to say lower cost? Comparative advantage. So therefore, beta would have the comparative advantage in apparel, and alpha would have the comparative advantage in electronics. So 26 is B. So A is not true, right? Because alpha has the lower cost. C, alpha must be specializing in apparel. Nope, you don't specialize and buy imports. Workers in alpha can produce more apparel per hour than workers in beta. But we'll actually know because if they did more apparel per hour, they'd be more efficient at apparel. So guess what? They would sell apparel, but that's not true. Consumers in beta buy more electronics than consumers in alpha. We don't know how many they buy. We don't. So it's not E. 27. Based on the graph above, demand pull inflation is caused by a movement from what? It's in the name. Demand pull inflation. So because it's inflation, you know that price level has to go up and it's demand pull. So it has to be with aggregate demand. So AD1 to AD2. Okay. Inflation is price level goes up and it's because of an increase in the demand. 28. A decrease in taxes will necessarily result in an increase in which of the following? So taxes go down, aggregate demand will go up. Okay, so let's see. Did this change nominal GDP? Yeah, it could, right? Because price level goes up and output goes up. So this could change the nominal. Output goes up, so unemployment goes down, not unemployment. Uh, Exports, maybe, right? But not really. We don't really know that one. Marginal propensity to save. Well, there was no mention of you saving more money. And then we had a decrease in taxes. A decrease in taxes, it does not change the money supply. So therefore, because prices and output goes up, nominal GDP has to increase. Which of the following will cause an increase in the equilibrium real interest rate? So the real interest rate is dealing with the demand for loanable funds and the supply of loanable funds. So how could we increase the real interest. Okay, well, what if we increase the investment demand? That'll do it. What if we increase the savings? Well, if we increase the savings, right, that would shift it from there to there. So that would be a decrease in the real interest. That's not going to do it. If we increase the government surplus, right, that would mean we have a surplus, which would mean that we are giving money back to the consumers. So that would be an increase in the supply. If we decrease the government deficit, same thing, right? We're actually increasing the supply of notable funds. And then if we buy bonds would increase the money supply, which would lower interest rates. So the only one that's going to increase the real interest would be A. 30. Which of the following will most likely promote long run economic growth? So again, long run economic growth. Which one of these is saying a change in technology, a change in the human capital, a change in productivity, okay, a change in something that's going to change your potential. All right, it's not going to be something that you earn on your savings. It's not going to be on food and entertainment, right? Because that's not technology. It's not human capital. It's not any of those things. What if it's funding for research and development? Well, that could be technology. There you go. If we decrease funding for law enforcement and judicial systems, no, right? Because we're having less funding for those things, we can't grow. Rapidly harvesting timber and mineral resources. So just because you can do it faster, that doesn't change your potential. If you found new resources, that would change your potential. But just because you can do it faster doesn't mean that changes your long run. Okay? So that was 21 to 30. Hope that was just as much as fun as it was for you as it was for me. I will be continuing on to 31 to 40 in the next video. All right, I'll see you there. Bye.